Hi, everyone, and welcome to another episode of the College Information Series. And today we are talking about everyone's favorite subject, loans, and we'll add in the word debt. And so for those of you who are watching on YouTube, welcome, and I hope this is helpful. And for those of you who are here, we are going to go through the presentation first. We're then going to turn on our cameras and have a Q&A session that won't be recorded. So if you are watching at home, I wish you could join us live. It's a lot more fun. Anyway, let's keep going. This is the financial aid series. And one of the things you're going to hear us say over and over and over again is that financing college is actually part of the college search strategy. It is a strategy, and it is based on the family's financial situation. Every family is unique, and it is based on the learner's unique academic background. These two things change the cost of college and change the strategy you need to use to make your situation financially the best it could be. The best financial aid, I'm going to say this over and over, the best financial aid comes from the college itself. Everyone keeps asking me about the magic scholarships. They're at the colleges, and you're going to learn more about that throughout our session. This is the second session. Today, we're talking about loans and debt. We did an introduction. It is supposed to be on YouTube, but I haven't put it up yet, so I will, hopefully by the end of the day. So we have our introduction in FAFSA. We have loans and debt today, and then we're going to be moving on to talk about merit scholarships and discounting, and then we're going to talk about need-based aid. These are all different aspects of the strategies that you can use depending upon your unique situations. Strategy, it is a strategy. And I am here to help you understand that strategy. You are always welcome to make a meeting with me. We can sit down and talk about your family's unique financial situation and what the strategies should be. But now let's step into loans. You notice I got two pictures here. I've got the family, I've got the individual pictures. This particular session is going to concentrate on dependent students because most students at iLEAD are dependent. We are talking about family situations. We do have iLEAD students that are independent. That is a little more rare. Typically, if you are kind of unhoused, if you are unaccompanied by parents, if you have been in foster care, a number of different things might move you from dependent to independent status. That is an individual thing that we can talk about. But for the most part, students that are going to four-year colleges are dependent students, which means the parents' incomes are involved. So we're focusing on that today. Okay, there are three types of loans, and we're going to concentrate on each one individually. Federal student loans, Parent Plus loans, which are also federal, and then private loans, which are from private lenders. So let's jump into each of these individually. The federal student loan, your basic loan belongs to the student. It follows the student, and it is through the U.S. Department of Education. Now, what's interesting and what a lot of people don't realize is there are specific limited amounts, and that keeps students out of trouble, or it's supposed to. You saw in our sort of thing that we did earlier, our questions, that there were limited amounts, and a student who is heading into their very first year of college cannot take out in their own name more than $5,500. This comes as a big shocker to a lot of people. It does go up over time. Second year is 65, third, and anything beyond that is 75 with a maximum of $31,000 that they can borrow. It doesn't mean that what they come out with is 31,000. We're going to talk about interest in a second, but this is it. This is all the federal government will give you for a four-year degree. No more than that, as long as you're a dependent student. Now, interest rates are set by Congress, and they change with each year. So at this moment, I went and I did a quick check before our presentation because every presentation I have a different number. Undergraduate loan rate is 6.39%. That will change, and in the end, you may end up with a number of different interest rates that can be consolidated together. But right now, that's not a pretty number, but that's just what it is for student loans. Okay, this is a really important concept. And that is student loans. And we're still talking we're still talking within that $5,500. They're not equal. You can get two different types of loans within that $5,500 umbrella, a subsidized and an unsubsidized. A subsidized loan tends to be income dependent. So up to a certain income, the government might subsidize a portion of your loan. And if you are beyond a certain income level, the entire loan will be unsubsidized. So what does that mean? A subsidized loan, the interest is being paid for by the government while you are in school up until about 6 months after you graduate. So that means the subsidized portion of your loan does not grow while you're a student. It does not gain any interest, and it is only part of a loan. So the entire loan, part of the entire loan is going to gain interest, but there may be a portion that is subsidized. Now, the unsubsidized portion, or depending on the income, the full amount of that loan for students is unsubsidized. That means the interest on your loan starts the day you take it out. That means you might be taking out a loan for $5,500, but you are not leaving school with $5,500. It has gained interest every day you hold the loan. And so be aware that what you take out when you're in school may not be what you leave with. It may be higher. And this is just something I want you to be very, very aware of. What this means, interest is paid by the government. It does not accrue, and the subsidized is need-based. I did mention this in the slide before. Unsubsidized starts immediately and it grows. So I thought those pictures are pretty effective, those money bags getting bigger and bigger, because it can be shocking to realize your loan is a whole lot more than you thought it was. Okay, so that's basics on the student. The student has a really limited amount of money they can take. There is the ability for the parent to help. Now, we have two loans that we talk about when we talk about parents. The first one we're going to talk about is the Parent Plus loan. That is the federal loan from the federal government. Both the student loan and the Parent Plus loan are from the FAFSA. The FAFSA is the form you fill out to make these loans accessible, to get access to these loans. What's really important about the Parent Plus loan is it belongs to the parent. And there are situations where the parent may think they're taking out a loan and the student might take it over. That will be a great discussion between you, but there is absolutely nothing you can do if your student decides they're not going to pay. It is your loan. It follows you forever or until you pay it off. It is a U.S. Department of Education loan, and the current interest rate is 8.94. And that changes. That's actually a little less than the last time we did this presentation last year. So I had to change that number. Cannot be transferred, requires a credit check. And for those of you who have students in college, things have changed. There are new borrowing limits. And this is something that has just happened with recent changes to the federal government. In that one big, beautiful bill, I don't know how to, I always get my words mixed up. These were some of the changes that were made in that bill. This is significant. It used to be, or it will be up until July 1st, that a parent can take up to the cost of college, meaning room and board, everything. So a parent can take the full rest of the loan out in their name to help their student pay for school. That has ended. You can now borrow a maximum of $20,000 per year per student. And that is it from the federal government. And there is a cap. You can only borrow a total of $65K per student total. So this changes things quite a bit for many families, and it's going to lead to some discussions that need to happen about how to pay for college. And we're going to learn these different ways. We're going to learn about scholarships. We're going to learn about other ways. But the federal loans, the loans that are protected by the government, the loans that are not given to you by banks that may have different reasons, you are now maxed out at $65,000 total for a single student. And this is just something new to be aware of. As far as I know, this is in stone. It was part of the bill. We'll see. Now, parent loans, the interest starts immediately. So there is no subsidized loan with the Parent Plus loan. It is growing while your student is in college. Repayment also starts right away. So you are expected to start paying it back. I think it's the year after you take it out, but you can defer the loan until after your student is done with college. So while it is a loan and they expect repayment, you can defer it. However, notice the image. That loan is growing. What some people do is they might pay on the interest to keep the loan steady. Sometimes parents will pay on their students' interest just to keep the loan steady. But it is a loan that sneaks up on you, and it is a loan that grows. There is no subsidized option for the parent. And I'm going to say it again, it does not transfer to the student ever. Your student is welcome to pay it if that is the agreement that you want to make, but you cannot hold your student to that agreement, not even after they graduate. It is your loan. It is being taken out in your name. So what do you do? What do you do if you can't pay for the full cost of college? There is another option, and that is the private loan. Often the private loan will belong to the student with a cosigner. So a student has no credit. When you're 18-year-old or when you are 18 and you are graduating from college, you can't take out a loan. You have no background that tells the banks you are a safe person to hand money to. So you can take the loan with a cosigner. Cosigner typically would be a parent. Sometimes it's a grandparent. It is through a private lender. So there are many, many banks that would love to lend you their money for whatever the interest rate happens to be. There are plenty of ways to get money for college, but you're going to need that student and parent together. There are no government protections or limits. There is no public service loan forgiveness, for example. There's no, when we had COVID, they actually put a stop to the requirement to pay back federal loans without interest. But that didn't necessarily happen with your private loans. That was up to the bank and what they wanted to do. So there are no protections with the private loan. You are at the mercy of the bank that has given you the money. And the interest rate is decided by the lender. It can be variable, it can be fixed, it can be high, it can be low. It may be lower than the federal rate. It may be higher than the federal rate. So a lot of times people will shop around for a private loan. And you have to look at the fine print as well to see what the requirements are. Are you going to be forced to stay with a cosigner? Can the student ever take the loan to themselves in their name and remove the cosigner? These all are different policies with private loans. So we've taught you how to get money, but now you got to figure out how to give it back. And that tends to be where it gets kind of scary. So let's talk about different forms of repayment. Now, I want to indicate that there are things in flux, that there has been within the last several years, former administration, current administration, there is discussion and changes and arguments about how loans should be paid back. So I give you this presentation with the knowledge of I'm not a financial aid advisor. I can only understand the paperwork that comes out from the government so well. In other words, not 100% well. And so I'm giving you the information as best I can. And we are also still looking at changes happening. So if you are going to be taking out loans, you need to keep an eye on what's going on with loans and decisions that are being made about repayment. With federal loans for student and parents, remember that is the Parent Plus and the Student Federal Loan, there are multiple repayment options. These options are currently in flux. There are some disagreement about how many different repayment options there should be. There are fixed plans that can last between 10 and 30 years.
I don't know what you're
Make
telling
sure
me, but
you have your sound off. There you go. And there are income-based plans, and the income-based plans are in flux. They look at a certain percent of your income to decide on what your monthly payments would be. There are different types of forgiveness. So there is forgiveness, meaning they wipe away the rest of the loan after the fixed plan. So, if you are on a fixed plan and you have agreed to pay it for 25 years, or excuse me, income-based, my mistake, income-based plan, and you agree to pay it for 10 to 15 to 20 years, there may be forgiveness at the end, especially as that interest grows. Usually it's taxed, but there is some forgiveness possible. There's public service forgiveness, and that is where you work for a nonprofit, a school, the government, and you can have your loan forgiven after 10 years of consistent payments. There are changes in the works for what organizations may or may not be acceptable for forgiveness, and we don't know what's happening, but that is under discussion right now. Maybe by the time we give this presentation next year, we will have some solid statements there, but we don't right now. Teachers, there's teacher forgiveness. There's forgiveness after extended payment. And also, if you are someone who ends up on disability, SSDI, SSI, a lot of times that is a time when a loan can be forgiven as well. If you are ever curious, there is the loan simulator. This is just direct cut and paste from the loan simulator on the federal government, the federal financial aid website. And you can actually run different scenarios. You can see what repayments would be. You can see what your different options would be. You can see what to do if you need to, if you're struggling and you need to put that loan payment off. You can see what happens if you add more to that loan and how much that would increase your payments. It's actually a really good app on the website. I've used it numerous times to kind of figure out how I might want to deal with my loan. And so I strongly encourage you to use it. If you already have loans, if you have an account, you can actually connect to that account and it will look at your information live. If not, you could put in your numbers and kind of see how that works. Okay, private loans. So that was repayment for public loans. Repayment for private loans, student and cosigner. I mentioned before, there's no government protections. For example, COVID gave us forbearance. The private loans can do what they want. Some private lenders offer relief, and some allowed for forbearance, meaning the putting it off, not needing to pay for it, not having that forbearance on your credit, but they didn't stop interest. And so private loans really are allowed to do what they want. And so you need to just be really aware if that's the direction you choose to take. There are limited repayment plans. There are multiple repayment plans for that Parent Plus, for that student loan, but private loans, they can set up the repayment plans that they want you to have. There is limited assistance if you are unable to pay. And if you and the student, or you, the student and your parent, if you have co-signed that loan together and one of you is unable to pay, then that loan is the other person is responsible. So let's say we have a student and they need another $50,000 to pay for school and the parent co-signs it and the student doesn't get a job and can't, maybe they really want to, but it doesn't matter. The parent is now responsible, even though the student had planned to or had wanted to, or the parent had assumed. There is also something that I actually saw happen within a family member of mine. And sometimes when you have a cosigner and one of those cosigners passes away, the full loan can become due. When I say look at the small print, I really mean look at the small print to see what the requirements are for your private loan. They're all different. And so I leave that to you as kind of a warning of things to research. And you're going to have to just see what each individual loan requires. So obviously loans should be used only after you've exhausted everything. And that's why we have 2 more sessions coming up. We have our scholarships and we have our need-based aid sessions, because if we can get that cost down and you can choose the schools that make the most sense, you won't have to go into debt. My goal is to do my best to help you find the right schools. And there have been situations with iLEAD specifically where I have had students come to me in spring after getting the dream schools that they wanted. I think it was like last year I had 3 like just come to me and say, I need to know how to pay for this. What do I do? And it's April and they've got to make a decision by May. And the answer is, there's nothing magic that you can do. You chose the wrong school. I didn't say that. I don't say bad choice. But what I was saying inside and secretly screaming was, you should have come to me earlier. We could have worked on this. So don't be the person that says, we'll apply and figure it out. Because sometimes figuring it out is $400,000. At this point, we have schools that are up to $100,000 a year. And if that's not what you want, we need to have that strategy, because we can also get you a school that's $10,000 a year. That is just as high quality. Or you may be a person that qualifies for very strong need. You may be a person that qualifies for nothing, but we can find you very strong scholarships. There are so many options. There's no need to be afraid, but you do need the strategy. So November 21st, December 5th, these are our sessions. Heather, we also have a concurrent enrollment. We'll just throw that in there, session coming. Is that next Friday?
It is. It's next Friday at 10 a.m. We're going to be talking about concurrent enrollment and also talking about dual enrollment, which we just started. We'll be starting in spring semester with Antelope Valley College.
So good things to come to. We have so many good webinars for you. We're so fun. And what I'm going to do is I'm going to say goodbye to our friends at home that are watching this on YouTube. Come and join the Q&A next time. And then we're going to stop the meeting and have our Q&A. So thanks everyone at home.